Amazing. Hi, everyone. Perfect timing. Just said amazing. And that's what Rachel is. We're super excited to have her with us today. I'm Allie Wyatt. As a reminder, I'm the co founder and CEO of Female Founder Collective and the 10th House. And as a friendly reminder, the 10th House is an amazing private community for female founders to be able to find each other by stage, by industry, by geography, ask each other the questions that they are burning to know, as well as to share resources with one another. And then we have incredible programming moments like these, where Rachel Springate from Muse Capital actually came in and gave us a whole sort of overview of the industry at this moment, which is a super important time. So without further ado, I'm going to get into it because we don't have a whole lot of time with her today, but I'm going to give a little background because she has very extensive knowledge and has had an extraordinary career. So she is the founding partner of Muse Capital, an early stage tech venture fund with a focus on underserved markets. She's originally from the UK, and she started her career in brand research, which created her network with Fortune 500s. Rachel was then headhunted to global head of corporate sales for luxury lifestyle group Quintessentially. She lived and traveled internationally, working with clients such as Cartier, British Airways, Jaguar, Goldman Sachs, and put together the deal that powered the Black Amex Centurion card. Throughout this international role, she also built her relationships with the music and sports industries, opening up her connections to sports teams, athletes, and talent. Her pivot to tech was in 2013 upon her meeting with Troy Carter, who's an angel investor, also with a fund. But at the time, he was the manager of Lady Gaga. And I actually didn't know the story. So it was so great to hear it because I didn't know all of this background. And now everything is making sense to me. That she started consultancy in NYC in 2013, working with early stage tech companies and leveraging her old network. And through this met Assia Grazioli, working on a Spotify deal. And then in late 2016, they created Total Magic and launched Muse Capital, a highly strategic fund putting together a combined 30 years of global network with expert business development knowledge to build companies for the next generation of entrepreneurs. Portfolio companies include Robinhood, BYJUs. I don't know this one, so you'll have to explain that a bit.
BYJUs is the Indian ed tech company, really.
Oh, got it. Clarity Money, Motherly, Mahmee, Beekeepers Naturals, Oath Care, and FlickPlay. But I want to talk a little bit about some of the questions that we got a bit into in your workshop, and that founders wanted a little bit more clarity on, because I think there are things that people get tripped up on all the time. And one of them is around competitive advantage. And that's that inside our workshop, you talked about the importance of providing competitive positioning for investors if you're a founder and going to market. And I also believe this, but I wanted you to speak a little bit more to maybe how founders should present that, when they're thinking about how they're presenting the exit opportunities that they have for their business. What have you seen that works really well and is really compelling?
For sure. I think one of our pet peeves, I think, at Muse Capital is when you go through a deck and there's like nothing on competition. And it's like, well, if you're not going to provide us with information on competition, we're going to go find it for you. So Why don't you just position it, like answer our questions by kind of just showing who's out there, but most importantly, why you're different and kind of why you stand out. It's a real opportunity for you to show the investor kind of, why you exist and what makes you better, just better than your competition in general.
Should founders ever worry that perhaps they're going to be planting a seed in your head or presenting a company that maybe you weren't thinking about in the competitive set and now you're going to?
No, because if we're a good investor, we're going to find them anyway. It's part of our job.
Right.
And it really is your opportunity to show, how you're different and why. And so it's never a bad thing to put in kind of, just a chart or a graph on kind of what's actually happening and where you're positioned. We're going to find the competition anyway. So why don't you make our job easier, but also just use it as an opportunity to show how much better you are.
I love that. And then as far as market opportunity, this is another thing that comes up again and again as far as how do you find it? And then to some degree, how you scale your business within a particular market, because you all are primarily tech investors. And I should actually, after this question, sort of back up. Sorry if my internet goes out. How founders might in the tech industry.
I think I lost you for a minute.
Basically, I was asking if you could help sort of define how, or help founders think about how they could go about articulating market size if they're not in the tech industry.
For sure. So as tech investors, we basically focused on tech because we're looking for multiples that are kind of tech size, and that is typically a 10x. So wherever you've invested in, the company needs to get to a 10x for us to typically invest. And then if you look at like CPG companies, the typical average exit is a 3x. And so if you're trying to go to tech funds with a product, you can still attract their capital, but you need to kind of paint the picture as to why, or how you could potentially achieve that multiple. And so something that's super interesting and really important, and we have made exceptions where we're tech investors, but we invested in a company called Beekeepers Naturals, for example, where it's a CPG product with a hero kind of throat spray. And I remember when we first heard about it, but we don't really do CPG. Then we met the founder, this amazing woman called Carly Stein. And the way that she actually positioned the vision of the company was like fascinating. And I'll tell you the way she positioned it. She's like, I'm not just this one product, right? I'm trying to disrupt the modern medicine cabinet. So if you go and look at, Dayquil, NyQuil, Benadryl, that are sitting on the shelves of pharmacies, there's this huge opportunity for better for you products. So without all of the horrible ingredients, she's like, the closest competitor is probably Zarbee's, but that was already acquired by like Johnson & Johnson. So look at this huge market opportunity. And, she went further to paint the picture of like looking at other companies that were CPG, that had reached like multi-billion-dollar opportunities. And so what was really fascinating for us is it's like, oh, wow, like this is a CPG company, but they're going to disrupt an entire category. And because of that, they can achieve the multiples that we look for. And so, a brilliant slide that we saw was looking at, and her messaging was amazing, right? She's like, okay, so the core ingredient of my product is propolis. And in America, nobody knows what propolis is. And propolis is like what bees have in their beehives that lines the beehive and protects the hive from bacteria and infection. It's the most powerful kind of antiviral there is out there. And she said to us, if you look at something like Vital collagen, the protein powder, hardly anyone knew what collagen was until Vital came along and educated the American public on what collagen did. And so we can do the same for propolis. Now, Vital is a multi-billion-dollar company at this point, right? And so by her positioning that way, by her like showing the potential and giving us the market comps, right? You could see this table and it had like Oatly, Vital Proteins, like, multi-billion dollar exits that were all CPG. And the moment we saw that, we're like, we're making an exception. She's a rock star and she's going to go and take over this whole category. And so again, in terms of market positioning for an entrepreneur, it's what are the comps that are out there and how can you help use these stats and facts and figures to tell your story and get the point across to the investor.
So I want to back up a bit because I do want to talk about Muse and your specific investment strategy and positioning, what makes Muse unique. because then I want to go into talent and partnerships, which is a big topic of conversation that our founders had and that founders always have. So would love for you to share a little bit more about Muse, and then I'll follow up with those questions.
So I think, our superpower at Muse is 30 years combined of working with decision makers at Fortune 500s, athletes, sports teams, influencers. We'd worked with them before in a business development capacity, and probably over the last 15 years now, doing that specifically with startups. To give you an example, like Assia was very early Spotify and helped the founder do the deals with like an AT&T and a Coca-Cola, or the equivalent in Europe, right? And so we've just had this real operational expertise of working with startups at the earliest stages and kind of bringing them those transformative partnerships, frankly, at a time when they need us the most, right? Or when they can't afford to hire people like us. And actually that's why we founded Muse, because we're like, why is it that there aren't more venture funds that are capable of doing the kinds of things that we do at the highest level? It feels like a missed opportunity. And so that was why we started Muse. And the idea was to be, in a market where there's a real overabundance of capital, we could provide something really useful and really different to the entrepreneur. So yeah, that's kind of our edge at Muse.
So let's talk about talent for a second, and then I want to go into sort of those more corporate partnerships, because I know they're very different. But as founders think about, getting a celebrity on board to their business, what are some of the ways in which you've seen talent be successfully onboarded to a particular company? And what, I know it's going to be a wide range, but how should they also think about economics and how they incentivize that celebrity?
So I think, the whole celebrity thing has just changed over the last decade in terms of, there's been this real move from endorsement to ownership. And that's because if you look at the high profile deals that were done a long time ago, I think of like 50 Cent and Vitamin Water, right? Yeah. That happened and everyone's like, wait, he made more money from that exit than he made his entire career. Like, how do I get? And it started this whole wave of all these kind of, celebrities investing in, the Ubers and the Spotifys, etc. And so they just got a lot more smart about kind of their value. And so I would say today it's so different. They typically have, teams around them who know how to do this stuff. They have their own funds. So in many ways, it's like easier because it's more accessible, but in other ways, it's harder. The one thing I will say is, I honestly think, paying people, it's not going to give you the best outcome. I think that the recent ones that work are ones that are super authentic, where they fall in love with the product and they use the product on a daily basis. Back to Beekeepers, it's unbelievable. Her product was so powerful that people like Lily Collins, when she was on the set of Emily in Paris, she was using the product and was like, this is incredible. Got in touch with the founders and like, oh, can I have some more? And it's like, well, if you love us, would you like to become an investor? And I really think that today, if you're going to do a successful partnership, the talent needs to put their money where their mouth is. I think that it's like, if they're invested with you and they're, going to win in the upside, then they should be investing, number one. And then, even with Beekeepers as well, the entire Kardashians and the Jenners just love it and use it and post about it, not paying one penny, because they love the product. Because
that's like the dream.
It is the dream.
That shows what having a good product does as well.
Good product, getting it in, understand what that's what the talent cares about, like what they love, and find a way to get them to try.
How would somebody get their product in the hands of people like that too, though? Because I think that's probably another big hurdle.
Look, there's many creative ways to figure this out. We're very lucky at Muse. We kind of have this database of kind of, the managers, etc. And so that's how we get our portfolio companies into the hands. But, I think that in Beekeepers' situation, she just, I can't remember exactly how, but there was like a gift bagging opportunity, like at an event, or, I don't think there's like a magic answer to it, but it's like however you can, like try and get that product.
Creatively.
Yeah. So whether it's like what events are going on, what gifting opportunities can we do, like what festivals, etc., are there where I can get my product, into the hands of influential people. But yeah, I think as long as you can, you have a great product that's authentic, that's where the celebrity stuff works the best.
And then you talked about the importance of certain benchmarks. We're going into a bear market. I think a lot of people are realizing there's going to be a huge shift, right, in how venture investors invest their dollars, but also how CEOs manage their companies and CFOs operate the businesses. Can you talk a little bit about the benchmarks? You gave some super helpful, very black and white answers, which is always just amazingly helpful for businesses that are trying to ensure that they are orienting themselves towards something.
Yeah, I mean, I'm sorry I can't share a table, but there's a couple of really amazing resources that are out there that kind of show, metrics you should be aiming for certain raises, like whether you're a D2C company, whether you're a marketplace company, and kind of how that's changed. And so, I mean, some top level stats here. I mean, the answer here is it's going to be much, much harder to raise money. You need to figure out how to get your burn to 2 years without having to raise money. If you do have to raise money in the next 2 years, you're going to have stats that back it up. And they're going to sound crazy, but it's like, if you look at your growth, if you're not above like a 2.5 times to 3 times growth, it's going to be really hard. If your margins aren't, above 50%, going to be very hard. Your customer acquisition, your CAC payback, your customer acquisition costs, you want that to be under, like ideally under 12 months, but maybe 18 months. And you really do not want to be spending more than you have, right? So when you look at your burn multiple, it's like, don't spend more than the revenue that you're making. And it sounds crazy given it obviously it hasn't been that way. It's like, money's just there to be, but everyone's hunkering down. Every investor is like, okay, unless you're giving me these kind of metrics, you're not going to raise money. And so if you're not at those metrics, you're going to have to look at reducing costs, reducing burn, and how do you get to survive like past this 24-month period. Mm-hmm. I think you're muted, Ali.
Good point. I was saying, if you can't hit some of those benchmarks, and this is probably a big question, right? What are some of the alternatives, right? Is it, and then I'm going to have to wrap this, even though I feel like I have 100 more questions for you. But, is it going out and looking for loans? Is it thinking about pivoting the business or looking at alternative forms of investment?
I mean, loans are going to be subject to the same thing. They're going to look at the metrics, right? And they're going to be, so that's going to be tough. I really think the only things you can do is look at your costs, right? So how can you get your burn down? So, you're going to have to think outside of the box in terms of marketing. You need to think more viral. You can't be paying, right? For, anything that's affecting your bottom line, you're going to have to really kind of hunker down on. And I actually really like these periods because this is where the true entrepreneurs like thrive, right? Because everything's a bit harder. You have to hustle more. You have to cut costs. You have to be really creative in your kind of business development and marketing, and focus on things that are going to grow your company when it's a really tough time. And that's when the best come out. And that's why in the last recession, all the best companies of our time came out of them. Uber, Airbnb, Dropbox, they all came out of the last crash.
It's amazing. Mm-hmm. Well, thank you, as always, for your time and your graciousness. And this is super informative, really helpful for me. And I know all the women that are, and men who are watching. So thank you. Really appreciate it, Rachel.
Great.
Thanks, everyone.
Thanks for having me, everybody. And good luck out there.